Imagine this. Two people retire the same year, same total savings, same investments, same everything on paper. One of them picks January, the other picks December, mostly because that's when their work anniversary happened to land. Same net worth walking out the door. Completely different first year of retirement, and the gap between them has nothing to do with the market. It has to do with a single date on a calendar that almost nobody thinks to plan around. My name is Eco Sticker, and I spend way too much time thinking about money, the hidden psychological traps of wealth building, and why people plan the year they retire down to the dollar and then pick the actual month almost at random. If you want to understand exactly which levers the calendar controls and why one specific month tends to set retirees up better than any other, hit subscribe and give this video a thumbs up if it ends up saving you a genuinely expensive invisible mistake. Here's the thing worth saying up front. If you've never once thought about which month to retire, that's not a failure of planning, that's just the default. Most people pick a date based on a work anniversary, a lease ending, or when family happens to be visiting. Nobody ever sits people down and explains that the month itself is a financial lever, several levers actually, that talk directly to your employer. The tax code, Medicare, and Social Security all at once, and none of those four forgive sloppy timing. Let's start with the lever, the big financial conversations almost never mention, your own employer. A lot of company retirement plans only pay out their full matching contribution if you're still employed on the last day of the calendar year, or if you've worked a minimum number of hours within that year, something often called a true-up. Walk out in September instead of waiting until December, and you can forfeit real money you'd already technically earned, sometimes several $1,000s of free matching contributions left on the table simply because the exit date landed one quarter too early. The uncomfortable reframe here is that saving more in your final working year usually isn't the actual win. Not forfeiting money you already earned is the win, and that's a completely different goal than people assume they're optimizing for. Then there's unused vacation and sick time, which most companies pay out as a lump sum in your final paycheck. Sounds like a pleasant bonus, and mechanically it is one, but that payout counts as taxable income in the year you receive it. Retire in mid-December, and that lump sum lands on top of a full year of salary, taxed at the highest bracket you'll likely see all year. Retire in early January instead, same exact dollar amount. But now it lands in a year with little or no other salary income, and the tax bill on the identical payout can look dramatically different. Same money, same employer, completely different outcome, purely because of which side of a calendar page it landed on. That leads directly into what's genuinely the master lever underneath almost everything else here, which tax year your income actually falls into. Retire on January 1st instead of December 31st, and something quietly powerful happens. That first full calendar year of retirement becomes a low-income year, often the lowest reportable income you'll have for the rest of your life, since there's no salary, just maybe some interest and dividend income trickling in. A low-income year is genuinely valuable because it's your window to do things that are much more expensive in a normal working year, like converting a slice of a traditional retirement account into a Roth while sitting in a low bracket, or selling appreciated investments and paying a meaningfully reduced rate, sometimes even zero, on the resulting capital gains. Under current tax law, a married couple can have a fairly substantial amount of taxable income and still qualify for a 0% long-term capital gains rate, but only if the income showing up that specific year actually falls low enough to qualify, which depends entirely on which year your final paycheck, bonus, and vacation payout land in. These low-income years, the stretch after work ends but before Social Security and required withdrawals begin, function as the single most valuable planning window in a lot of people's entire retirement. And the month you retire either opens that window wide for the full first year or slams it half shut by stacking a huge chunk of taxable salary and payouts into what should have been the low-income year. There's also a meaningful and fairly recent tax provision worth knowing about here specifically because of how timing sensitive it is. Certain age-based deductions available to people 65 and older start phasing out once income crosses specific thresholds. A sloppy, high-income final working year doesn't just cost more in tax that year, it can quietly shrink deductions that would otherwise have been available, purely because the income from severance, vacation payout, and a partial year of salary all landed in the same 12 months instead of being spread more deliberately. Now, all of this only works if you actually know your real number, the honest monthly spending figure retirement needs to support. Not a rough guess, the actual number, because every lever described so far depends on being able to manage reported income deliberately, and managing income deliberately is impossible without first knowing what you genuinely need to live on. Let's move to the piece that trips up more retirees than almost anything else on this list: health insurance, because here the calendar stops caring about the month and starts caring about the exact day. Employer coverage almost always ends on the last day of the final month worked. If the next source of coverage, Medicare, a marketplace plan, a spouse's plan, doesn't start the very next day, there's a coverage gap. And a gap at this stage of life is not a small risk to carry. Here's a second trap that's invisible until it's already too late: the deductible reset. Say a heavy medical year happens, and by October, the annual deductible and out-of-pocket maximum are already met. Retire in October and switch to a new plan, and that new plan resets the deductible back to zero immediately, meaning the same out-of-pocket maximum effectively gets paid twice within a 12-month stretch. In that specific situation, finishing out the calendar year on the existing work plan and switching in January onto a fresh deductible in a fresh year is often the better move. There's also a newer wrinkle specifically affecting anyone planning to retire before Medicare eligibility and rely on marketplace coverage in the meantime. Enhanced subsidies that had made marketplace insurance meaningfully more affordable for early retirees expired, reintroducing a sharp income cliff, cross a specific income threshold by even a small amount, and a subsidy can disappear entirely, sometimes pushing premiums up dramatically to maintain identical coverage. For anyone retiring early and relying on marketplace insurance, the income reported in the retirement year directly controls the health insurance bill, which loops right back into the same tax year timing question from before. It's all connected. None of it operates in isolation. Two more traps cluster specifically around age 65, and they're worth understanding even if that age feels distant. The first involves health savings accounts. Anyone still working past 65 with a high deductible plan and an active HSA, while deliberately delaying Medicare enrollment, needs to know that Medicare Part A enrollment backdates, reaching back up to 6 months once it activates. Once that backdated coverage is active, the legal HSA contribution limit for that period drops to zero retroactively, meaning contributions made during those backdated months become excess contributions, carrying an ongoing annual penalty until corrected. The practical fix is simple once you know about it. Stop HSA contributions roughly 6 months before enrolling in Medicare. The sneaky part is that claiming Social Security can automatically trigger Medicare Part A enrollment, whether that was intended or not, meaning one decision can quietly detonate a completely separate one without any obvious connection between them. The second trap around this age is the income-related surcharge on Medicare premiums, sometimes called IRMAA. Medicare looks back 2 full years when setting premiums, meaning a given year's premium is actually determined by income reported 2 years earlier. Cross certain income thresholds in that earlier year, even by a small margin, and premiums can jump meaningfully, sometimes by well over $1,000 annually. And if both spouses are enrolled, that increase applies separately to each. A December retirement stacking a full salary, a large vacation payout, and a bonus all into a single tax year doesn't just create a bigger tax bill that April, it can reach forward 2 full years and quietly raise Medicare premiums during a period when income has already dropped substantially. Social Security and required withdrawals bring their own version of this same timing sensitivity. Benefits are calculated based on the specific month claimed, and claiming a few months earlier or later shifts first-year income and how much of the benefit ends up taxable. Required minimum distributions carry a similar wrinkle. There's an option to delay the very first required withdrawal until April of the following year, which sounds appealing, but doing so forces two separate required withdrawals into that following calendar year instead of one, potentially doubling reportable income in a single year and pushing straight into the same Medicare surcharge territory described earlier. Even years after the actual retirement date, timing decisions keep rippling forward. So, pulling all of this together into something usable rather than an overwhelming list of rules. For most people, retiring on January 1st or very early in the calendar year tends to be the cleanest structural choice. The first full year becomes a genuinely low-income year that can be shaped deliberately. A vacation payout lands softly instead of stacking onto peak bracket income. A fresh deductible starts a year that can be planned around in advance. And those valuable low-income gap years for Roth conversions and favorable capital gains treatment open up as early and as fully as possible. But this is exactly where judgment matters more than a blanket rule. If a deductible and out-of-pocket maximum were already met after a difficult medical year, finishing that year out on the existing plan can genuinely be the better move. If a bonus or a vesting milestone lands early in the following year, waiting for it can be worth far more than an earlier exit date. If an employer match fully vests specifically at year-end, walking away a single day too early can forfeit real money. The right month isn't a universal answer. It's whichever month actually lines up someone's specific levers, and now those levers are at least visible instead of invisible. Here's the practical version of everything just covered. One phone call to HR can surface the handful of numbers that actually matter. The exact day insurance coverage ends, how unused time off gets paid out, when a match fully vests, and whether any bonus or stock award vests early in the following year. A quick look back at a recent tax return reveals the income baseline that determines Medicare premiums 2 years out. And an honest accounting of real monthly spending in retirement turns all of the abstract timing advice into something that can actually be applied to a real date on a real calendar. None of this is about controlling the market, because nobody actually can, and trying to time market movements around a retirement date is a losing game from the start. This is about controlling something entirely different, something that's fully within reach, the specific month a decision gets made. That single choice quietly steers taxes, Medicare premiums, health insurance costs, and Social Security taxation all at once, which makes it one of the more consequential financial decisions in the entire retirement process, and also one of the only ones that's completely, entirely controllable. So here's where you actually stand now. You know why the employer true up and vacation payout timing can either preserve or forfeit real money, depending on the exit date. You know why the tax year itself functions as the master lever, opening or closing the window for low-tax Roth conversions and favorable capital gains treatment. You know the health insurance traps hiding in the deductible reset and the marketplace subsidy cliff. You know the two traps clustering specifically around age 65. The HSA backdating penalty, and the Medicare income surcharge with its 2-year look-back. And you know that Social Security and required withdrawal timing keep the same logic rippling forward even years after the actual retirement date. You don't need to have every single one of these variables perfectly optimized before picking a date. You need 4 specific numbers from HR, 1 look at a recent tax return, and 1 honest monthly spending figure, and suddenly an abstract calendar decision turns into a concrete, deliberate one. That's the entire mechanism. Pick the month on purpose, instead of letting a random date pick you.